Today we are focusing on Eve Holding, Inc.
Right, Eve Holding. And as the source material shows, they're positioning themselves not just as, an aircraft manufacturer, but really as a full ecosystem provider, developing eVTOLs, these specialized service and operation solutions, and crucially, the urban air traffic management or UATM systems, which are just vital for any kind of scalability here.
Exactly. And that brings us to the core question today, which is fundamentally about valuation in such a nascent industry. Given Eve Holding's current zero revenue profile and, let's be frank, substantial financial losses, is its $1.45 billion market valuation justified primarily by its future market positioning and its strategic capital? Or does this valuation fundamentally overlook the really critical execution challenges and maybe the balance sheet instability inherent to pre-revenue aerospace development? I'll be arguing that the market premium is actually justified by the company's forward-looking strength, rooted in its intellectual property moat and what I see as an impressively robust liquidity runway.
Okay. And I'll be taking the view that while the vision is certainly compelling, the current, $1.45 billion valuation critically underweights the very tangible financial risks embedded in Eve Holdings' financial reality and just the pervasive uncertainty surrounding commercial aerospace execution and, of course, regulatory approval.
So, look, the valuation reflects Eve Holdings' status as, I think, a first mover in a genuinely revolutionary, high barrier to entry industry. We really must evaluate it based on future potential, not, standard manufacturing profitability metrics. What gives me confidence is that they've stacked the deck with cash for this high-risk development period. The company is, frankly, exceptionally capitalized for its intense development stage, a fact immediately visible right there on the balance sheet. Their liquidity is robust, with a quick ratio and current ratio both sitting at a strong 2.77. That signals an immediate and pretty robust financial buffer. This runway has been continually supported by key recent funding events, including a significant $230 million equity capital raise and also a $92.5 million line of credit secured from BNDES.
I would frame the financial data rather differently. I'd focus squarely on the rate of capital destruction rather than just the amount of capital raised. If we look at the income statement, we're observing profound losses. Eve Holding reported zero sales, but suffered an income loss of nearly $190 million, specifically minus $189.95 million over the trailing 12 months. This isn't not just normal R&D spending. This scale of loss has translated into severely negative metrics that reflect, a deep consumption of equity. For example, the return on equity, the ROE, sits at a staggering minus 320.52%, and the return on invested capital, ROIC, is minus 113.44%. Stated simply, the company is currently destroying more than $3 of equity for every single dollar invested. But the most alarming metric for me is the speculative valuation relative to tangible assets. A $1.45 billion market cap compared to a book value per share of only 5 cents. Well, that results in an extreme price-to-book ratio of 106.65. This reliance on future, unproven success is just, it's palpable.
But for a pre-revenue development company in a capital-intensive sector like this, those metrics are functionally irrelevant until they hit commercial scale. The focus must be on the runway required to reach that viability. The crucial indicator, I think, of immediate financial health is that the enterprise value of $1.36 billion is actually less than the market cap of $1.45 billion. Now, this is a technical signal, sure, but it means Eve Holding holds a healthy net cash position on the balance sheet. They have more cash than total outstanding debt. This buffer, continually bolstered by that recent $230 million raise, secures crucial capital necessary for navigating the extremely challenging multi-year FAA certification period. They have the time and, importantly, the funds to execute.
The massive cash raises, they only address the symptoms, right? Not the underlying bleed. The $189.95 million in operational losses over the trailing 12 months, coupled with a negative EPS forecast for next year of minus 65 cents, clearly indicates that the current cash reserves will be consumed rapidly. Developing a certified safe aerospace platform is astronomically expensive, and those development costs escalate as they approach final integration and testing. Liquidity in this context, it's merely deferred insolvency without a demonstrated successful commercial path to generating sales. The sheer pace of expenditure, I believe, outweighs the momentary comfort provided by the cash buffer. They are burning through cash faster than they can truly secure the commercial outcome.
And since we are talking about the sheer magnitude of risk here, let's pivot back to that staggering valuation metric. The price-to-book ratio of 106.65 is, I think, symptomatic of speculative excess across the entire eVTOL market. Paying over 100 times for tangible equity is like buying a vacant lot purely based on the hope that you'll be able to successfully build a massive skyscraper there, while ignoring the complex permit process, the rising cost of materials, and the fact that you haven't even laid a single foundation yet. Furthermore, while high insider ownership, 84.5%, can signal commitment, yes, combined with a small share flow, only 46.64 million shares, it amplifies volatility and can distort market pricing. It leads to significant, sharp price swings. Just witness the minus 32.25% performance in a recent quarter. Retail investors, despite the beta of 0.75, are heavily exposed to this price instability driven by, hype or even minor developmental setbacks.
I view the high insider ownership not as a cause of distortion, but as essential alignment. It demonstrates that the leadership is deeply invested and committed to the long-term vision, which actually mitigates the risk of short-term distraction. Regarding the extreme valuation, the premium is focused on the intangible assets that secure their long-term market position. Eve Holding isn't just selling aircraft. They are, in effect, creating the operating environment. Specifically, the proprietary Urban Air Traffic Management, or UATM system, is a foundational piece of their value proposition. This software will be absolutely crucial for managing the complex routing, scheduling, and infrastructure necessary for the scalability of the entire ecosystem. Investors are paying a premium for the future toll booth operator, so to speak, not just the vehicle manufacturer.
Software systems are notoriously less proprietary in the long run than certified aerospace hardware, aren't they? What prevents a major competitor, like a drone traffic management system provider, or maybe even a deep-pocketed tech firm, from developing a functionally equivalent UATM system? That could erode Eve Holdings' alleged moat, particularly if certification of their eVTOL hardware gets delayed, which is always a risk. The premium you're describing rests really heavily on the assumption that this UATM system remains proprietary and dominant, and that's a major technological risk in the software sphere.
Well, the counterargument there is that their UATM is being developed in parallel with their hardware and their strategic partners, giving them a vital integration advantage. And this brings us to the operational momentum. Eve Holding is aggressively mitigating market feasibility risk by focusing on an integrated air transport ecosystem. Recent letters of intent, LOIs, such as those with Revo and, significantly, United Airlines, demonstrate established external demand and market acceptance. United, for example, didn't just issue an LOI, they actually invested $15 million. That provides pretty clear validation of the business model, despite the demanding and, yes, naturally protracted certification process.
But we do need to address two critical risks inherent in their history. First, regarding the LOIs themselves, are they truly binding contracts, or are they, more like reservation tickets that can be easily abandoned if development slows or costs increase? The fact that they're called letters of intent suggests they carry far less weight than firm orders, wouldn't you say? Second, and maybe more importantly, we must return to the immediate and historical regulatory and legal hurdles stemming from the SPAC merger. The history of financial disclosures post-merger is, concerning. The Q2 2022 financial statement correction involved non-cash expenses and complex adjustments related to warrant accounting.
This specific issue led to active securities investigations. And for our listeners, it's important to note that the difficulty in accurately valuing SPAC warrants has historically signaled structural weakness in corporate governance and led to several regulatory headaches across that whole sector. This instability creates a critical legal and financial overhang on the stock that really must be factored into the valuation, regardless of future technology success.
I agree that the complexity around SPAC warranted created uncertainty, which needed correction, but the company has addressed those issues, and the continued funding and that deep insider commitment suggest that the fundamental operational goals remain on track. The core case for EVE Holding, for me, lies in its secured capital runway, evidenced by that robust balance sheet, combined with validated market interest via numerous LOIs and that deep internal ownership commitment. This strategic positioning maximizes their probability, I believe, of capturing the nascent UAM market once those critical certification milestones are achieved, justifying the forward-looking valuation today.
While the potential market is indeed vast and potentially transformative, the current financial reality is one of high expenditure, those operational losses approaching $190 million, and extreme valuation metrics, notably that 100-fold premium to book value. This valuation is exceptionally sensitive to execution delays, regulatory challenges, and the potential for increased competition, especially in that UATM space we discussed. Investors must continually weigh the revolutionary potential of eVTOL technology against the very tangible risks of financial instability, the lack of commercial revenue, and yes, those lingering corporate governance concerns tied to their merger history.